Hello, everyone. Welcome to today's session. Let's jump right into it here, looking at market conditions. Let me get rid of this. Uh, Weakening just a little bit today. Let's start out with direction alerts. We are at the upper end of this range, sitting right at this bull market rank of 22.50 and really matching the most recent high here as well. So, and we are definitely into that extreme range. That being said, that extreme range is a slower process. We've kind of felt that really since this range, and it can turn. But we have seen, it only takes 3 or 4 or 5 days of volatility and reversal to start to pull that back down a little bit. We are seeing it's an interesting pattern happening. We'll look at SPY right here. In the short term, we are seeing momentum that's kind of stuck in the range, working its way back towards that bullish trend zone, and breadth indicator is stuck right in the middle here, as is the buy-sell ratio. We'll look at that right now. In fact, buy-sell ratio is sitting right at 0.81. So with the bears in control, just slightly 1500 to 1200. So relatively flat, just kind of a tug of war happening still, without a lot of extreme happening. We are seeing S&P 500. Let's jump in and look at that, having a little bit of a retracement the last couple of days. I'm going to come over and take that off just a little bit so we can look at those candles, and you can see the support area. Two of the ranges that we've been talking about on S&P 500, one is right here where these recent tops have been. We have the bottom of this little gap range, and we tested that, and we also kind of tested deeper than that. We tested this entire chunk really, yes, two days ago, and we got that bottoming tail bar happening right here on S&P 500. Increasing volume as well. And then yesterday we almost had another bottoming tail bar, a little bullish hammer pattern right there. So today, another indecision type day. So we had two buying days and then an indecision day. There are two things that are happening today that I also wanted to point out, that are interesting. One is we have TLT up big today. I mean, big is 1.5%. And up big yesterday as well. So as we were pulling off this bottom range right here, let me go into the 1-year time frame, and we had talked about this rounding process and this bottoming, a little higher low, can find some support. It was starting to really slide on that 1 year, on that 6-month time frame. This 1-year time frame, we're still in that bearish trend. You can see that the 1-year time frame, the fib tool is grabbing the swing high and swing low of this time frame, and there's a high that is this direction. It'll automatically grab the high if the high is this direction and the low is this direction, but there's still a high over here that is in place, and so that's making that trend down. So all of these fib levels are still bearish. Okay, they're resistance areas, and so that's more work for the bond market to do. But a big bounce off of this range and clearing up into this range. Let's go back to that shorter time frame and see where we're at here as well. So even on the 6-month, we're still in that time frame, but now we're clearing back up. Remember that on the bearish trend here, this still acts as the momentum zone to the downside. So if we have a bearish trend and we're counter trending up to that 236, and in this case the 382, so we're seeing a really strong move in bonds today. That is significant because the bond market, the inflation, what the Fed's doing, the bond market, at least as of right now, as of the last 2 days, believes that interest rates are coming down and that inflation is in check and that the Fed is done. Okay, or at least that is the perception. That's the perception of 2 big up days in the bond market. Now, in addition to that, we also have, if we go over here to sectors and commodities, we also have, at least as of this morning, we had oil selling off pretty aggressively. Okay, so you can see now oil, let me come back to this perspective because we've been using this now mostly, is it got stuck in this range. It's still an uptrend zone, or an uptrend. You can see here we've snapped to this and this high and this low, retracing 618. Now we're at the lower end of that. So we've had a pretty nasty retracement just in the last 3 days. So we had an aggressive retracement in oil. We had a strong rally in bonds. The stock market as a whole hasn't done much, but those are two things that should add some additional bullishness to the bullish case. Okay, that this pullback is just a pullback, and we're seeing really these last 2 days when you saw S&P 500 buying right here, where oil is dropping significantly, bonds are rallying aggressively. The other thing that is of interest, and that is, so when we see inflationary type of situations, and typically commodities will lead that rally, because think, everything's leading, but commodities are going to be heading up as well. So we've seen gold moving higher, we've seen silver moving higher. Gold has not moved yet, or broken down yet, but we are seeing some of these names in, let's go to the portfolio. We've got 2 names in the portfolio currently that are kind of giving back some significant gains here. Let's go here. USAP, which is that basic material steel producer. So you're seeing some of these names pull, at least retrace and pull back into that support at that upper end of that range, that 236. That's going to be interesting to see if we do start to see oil. So this is a gold stock starting to pull back. I mean, everything's pulling back today for the most part, but we are seeing a little bit of retracement in some of those names that have had big run-ups. That could be also kind of a rotation or a shift over into other things. We are seeing a rally in some of the crypto trades. Coinbase, which is up today 5%. We do have that in our in the portfolio. MicroStrategy, MSTR, 2%. This one is really more of a crypto or a Bitcoin proxy, and it shows up in all the scans anytime crypto is moving, because they are, almost all of their cash position is in Bitcoin, and so it's become this proxy for Bitcoin itself, even though the company really has nothing to do with it, but they've got a large cash position there as well. So that's one of the reasons, if you're seeing those show up in the new buy list, and that's $1,600 per share. On some of those, at least on that name, pretty expensive, similar to Nvidia. And then we've seen GameStop. I don't know if any of you are following GameStop or did back in the day. This is just an ugly, messy chart. I wouldn't rely on any of the signals at all when it comes to stocks like this, because it's 100% manipulated by everybody right now. So those are, unless you're really, really good at real short-term trades, both long and short, I wouldn't go near those. But it is a stock that is tracked and it's showing up, and it's interesting that it is showing up for some of those trades today. We're seeing a few other things. We're seeing Murphy oil here towards the upper end of the range. We did make a new trade today on DKT, that new buy signal, a little bit of a retracement there, but nice looking pattern. So there are some things that are working here currently. Spotify is also breaking out today, and that was a new buy, gone from hold back to buy. So again, the process typically, in terms of the trading system or the plan, in terms of what am I looking for and when, we'll talk about this. I'll just kind of reiterate that process today, and that is, it's an end of day system. So we're primarily focused on the signals after the market is closed or before it's opened. Okay, obviously we can do other things too during the day if maybe we've missed something and the bar is not that far from our entry, or even if it's like, okay, this is close enough to that low point, or we're only 2%, and I'm still going to make a trade whether or not I did anything before or after. But ideally, we find the trade in advance before the market opens. Then we can set it up and set up the buy order in advance. So when the market opens, we automatically get filled at the open, and then we have our stop loss in place, and that's about it. There's not a whole lot we have to do. But remember, the two important things in this process are saying, all right, I'm going to buy this stock at the open. Okay, so again, this is going to be back here. If I were to pull this back and just get rid of that day, this would be our perspective if today hadn't happened yet, or pre-market. This morning, this is what this would have looked like. And I would have said, all right, I want to buy this stock today. So what do I need to do? I'm going to, number one, decide my position size. Now, in this case, I'm using this $100,000 portfolio just for round numbers. If your portfolio is more or less than that, then go in and set one up. Just set up a practice mock portfolio. And then when you're looking for your position size, you're going to be relatively close to whatever that amount of capital is that you're trading for the position size. In this case, if it's 100,000 and I've got to determine this portfolio at risk. So I start out with the number of shares. I know that it's 300, so 10 shares is going to be a lot. Okay, so we're at 3% already. That's too much. So I need to come back down to maybe 7 shares, maybe 6 shares. So now if I were in this position and I said, should I go higher than 2% or lower than 2%? If our benchmark is for 2% at risk, then you can decide. In market conditions where we are a little bit more conservative right now, I would probably round down in that case and say I'm going to round down to 1.86% at risk of my 100,000. Let me get my drawing tool. Of my 100,000, then my amount at risk is $1,900, okay, about 1.9% of my 100,000. So that means that I am putting at risk all of that money. Now, does that mean I'm potentially going to lose all of that money? No, not with a stock like Spotify. Now, if I were trading an option and it had an expiration date or something like that, then yes, there is a chance that all of that money could be gone. But in stock trading, the probability of me losing all of that money is very, very low. But the probability of it gapping maybe down 20 or 30% or even 50% is definitely a possibility on any stock as as we deal with earnings or you deal with litigation, or if it's a biotech, maybe you're dealing with FDA approval, and those can gap the stocks around pretty aggressively. So risk profile parameter number one is always portfolio at risk. How much am I risking? If I have a $10,000 account, I would still do the same thing. I may not be able to buy anything if that is the case, because a $10,000 account, if I have one share, that's going to be with no stop loss in place, $322. That's going to be of 10,000. That's 3% of my account at risk versus 2%. Again, if you're okay with that, then that's the one share that you would be able to buy. If not, be like, okay, well, I'm going to pass on this one. It's too much of a risk or too big of a position size for me to manage effectively. Okay, let me go back to that 7 shares. Now, the second part, we're obviously not going to risk the full amount. Oh, I used 6 shares, didn't I? Let's go down to 6 shares. Okay, we're obviously not going to risk the full amount because we can place a stop loss. Now, a stop loss, just to reiterate a few of these things, a stop loss is simply a function inside of your brokerage account that says if the stock trades below a certain level, I'm going to stop out of that trade, which means I've got an order already set up in the brokerage account that says if it ever gets to this price, let's call it 288. If it gets to 288, I'm automatically going to sell. The brokerage platform will automatically sell for you. So you don't have to be watching it. You just simply set up the stop loss at a location that says if for some crazy reason it drops, not crazy, it happens all the time, but for some reason when it drops, we want to make sure that we are not in a situation that we are now like, oh, it's going to bounce, 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 and it never does. And now we let a trade turn into a long-term dog investment because now we've just, we can either sell it. What most traders do is just hold on to it and say, well, all right, whatever, we'll just sit and wait. Okay, a second bad decision on top of the first bad decision. Okay, the first bad decision is not having risk parameters in place or a stop loss in place. That being said, you don't have to have a stop loss. If your risk parameter and your risk profile is this alone and said, I'm going to risk $2,000 on this trade and but I'm not going to have a stop loss in place to begin with, just because I'm okay with all kinds of volatility. Okay, that doesn't make much sense for us in this strategy, in this methodology, but you can certainly do it because it is a little bit easier. And sometimes you will have stocks that retrace 20 or 30% and then immediately bounce and immediately head back higher, particularly in a bull market. But in terms of keeping things consistent, having a stop in place is a wise practice. And typically in this method, you can go right below either the most recent hold signal, if it goes from a hold back to a buy, or the 236 on a 6-month time frame also works nice, as because now we know that we want any stock that's going to stay in this momentum zone. We want it to stay here and have some volatility, and then break up here and then move higher. Okay, and then come volatility and then move higher, volatility, move higher. Okay, at some point, our initial capital, that initial 2,000, this is not, okay, this is our hard-earned money. This is not house money. This is not profits. This is not gains. This is this is my wages. This is my, this is all of our back-breaking money. So we don't want to be flippant with it. We don't want it to be Vegas money. We want it to be a very systematic process. But that being said, we have to take risk. There's no way to not take risk when we're doing this. There's always a risk. Okay, so we want to make sure we understand the very best we can what that risk is, and these are really the only two ways to do it. Okay? The other way is to say, well, I've determined, because I am clairvoyant, that Spotify is God's gift to stocks and it's never going to go down. Okay, who can do that? It's certainly not me. Okay, maybe some people can, but I can't. And so, I think that in terms of knowing the future, that's pretty tough for people too. So we have to take some risk with uncertainty, and that is the risk. The risk is the uncertainty of what's going to happen to my $2,000. Okay, is it going to go up or is it going to go down? Well, we don't know, but our anticipation is that it's going to go up. Our edge is that it's going to go up. Our strategy is that it is going to go up. But when it doesn't go up, we don't want to have a position that is too big. We don't want to say, oh my gosh, I know Spotify is going higher, and so I'm going all in on this. I'm going 25 shares. I'm going 8,000. I'm going 10, 12,000 into this trade. Okay, and because I don't believe it's going to go higher. Well, the second you have too big of a position, the market is going to find you and it is going to create pain for you. That's the market's job. The market's job is to remove money from you. Okay, it's our job to protect that money. It's also the market's job to make us the money. It's not our job to make the money. It's our job to protect it, and the market ultimately has all of the control. So we want to make sure that we're doing the best we can to create an edge and look for opportunities and have a systematic approach in both buying and in managing the risk. So let me just go back to the 6 shares. Now our stock price, let's call it that. Let's go a little bit lower than that. I'm mousing over that low and I'm looking at 286. So let's go 286. That's 0.21. Okay, so with a stop loss, that 286, that's the line in the sand. We buy it today, this morning. Okay, now we obviously know that what happened, and that is, let me get rid of this, and that's, here we are right here. Okay, so now we're up 2% already, and our stop loss is down here, and we're in the trade. We would have pulled the trigger and said, yep, sure enough, I'm good with my 6 shares. I'm good with a $286 stop loss price. That means that if I'm wrong on this, or if I shouldn't even say it that way, I don't like to say it that way because it's not me being right or wrong. Okay, we're simply following a process for a stock that we think is going to go higher. It may or may not go higher. So if it doesn't go higher and we get stopped out, it doesn't mean I'm wrong. It just means that I got stopped out. It's going to happen. It's going to happen probably half the time. Okay, it may not happen on the initial trade. It doesn't happen to us very often on that initial amount. But because we move the stop losses higher, we eventually get stopped out. But getting stopped out, we still may have made money. We still may be profitable on the upside. Okay, that is the buying process and understanding your risk. So let me go back. If it does stop us out at 286, we are going to lose $219. Am I okay with that? What does that mean? How many of those could I have before I need to have two or three more winners? How many times could I have this loss and still be able to play the game? Okay, that's why I say I say a game, but it's really not. It's really it feels like a game sometimes because we're moving pieces, we're moving players around. Okay, we're moving chess pieces around. And we're making, we have a strategy towards what we're trying to accomplish. And that is fine because it needs to be a framework. It needs to be structured. And that's what we're providing for this overall mechanism. There's a million ways to buy and sell stocks, okay? But if you choose a million ways, you're going to drive yourself nuts, because you're going to have bought on from one method and sold from another method, and set up your risk from another method, and set up your exit on another method, and your trailing stop on another method. Okay, that's just asking for chaos. Just pick a system and stick to it, and manage your risk. If the risk is an issue, trade smaller. I always will say this: trade one share. If you are not comfortable, even if you have $1 million portfolio and you're not comfortable buying and selling stocks and setting up stop losses and knowing why you're buying, buy one share. Okay, because you can. Commissions are next to nothing. If anything, they're an insignificant part now of trading, which is great, because now we can trade with real money, but really small money to learn. And real money is better in most cases than a simulator, but it's because it adds that emotional aspect, but it doesn't add a lot of emotional aspect if it's a really, really small position size. Don't worry about FOMO. The fear of missing out is a very real thing. And it's like, well, I'm doing this, so I might as well do it with a lot of money. Okay. And so that's one approach. But if it's going to be, if you want to be able to feel like it's a refined, smoother process, and it's really not that difficult, especially if you were to go in and use a simulator and set up 20 trades and do it for a month, you're going to know what you're doing. Okay, it really is a simple process to be able to do. The hard part of the process is sticking to it. Okay, the hard part of the process is now entering the trade and then watching this and saying, oh, it just went up, oh, it went back down, it's getting close to my stop loss. Should I wait? Should I buy more? Should I sell? Should I? Okay, all of those questions you should never be asking. Why? Because you've answered them right here. Okay, you've answered the question in that, what am I going to do if I get to 286? What do I still have right here? What am I going to do at 286? I'm out. Big deal. That's not a hard decision. It's not emotional. It shouldn't be. I'm out $200, but the trade-off is, oh, I still have one share there. That's why it's showing. The trade-off is I could make a whole lot more from this stock. My expectation is that I'm going to make more over time, but and if I'm doing that across 10, 15, 20, 30 trades, we end up trading about 20 trades a month. So, and those are coming and going. We're adding, we're subtracting, we're buying, we're selling, we're managing this portfolio of stocks that are really dynamic and doing a lot each day. And the market is always changing. And we talk about that. The past performance is no indication of future performance. That's very real. Every day is different. And so, we have to be able to be okay with series of times in the market where we may be flat. There's going to be times where we're doing very well. There may be times where we have drawdown, but this number is the most important part every single time. Now, this is more about the entry process, the exit process in managing. We'll cover that a little bit more maybe on Thursday, but I wanted to go through that because as you're going through and you're seeing a lot of these names, particularly here, say it's Coinbase, and you had an opportunity to buy and you said, yep, I want Coinbase. All right, so now what? Now what do I do? Well, you've got to decide the number of shares. You've got to know your portfolio amount. This doesn't have to be your full portfolio. This is just the amount that you're trading with this method. You might have $1 million, but you're trading 10,000 in this method. Okay, you use the allocation method number that you're actually trading, just so you get a good number or close to it. If you're close to that, if you're 2.14 versus 2%, obviously that's going to be close enough. If the share price is too expensive to buy more. So I would go in and I would say, what's my risk? I'm sticking to that 2%. How many shares do I need? It's a $300 stock. We just did one of those, so it's going to be close to 10 shares. We could go a little bit higher. We could go 9. 9 is going to put us at 2.11. 8 is going to put us at 1.88. In this case, I'm going to round down just because I want to be a little bit more conservative. And I'm going to set my stop loss below the chop, or ideally below the most recent hold signal, or this cluster. You can also use the Fibonacci ranges. okay? And then sometimes if it's close enough, I'll go halfway between those two zones. So if we were to say, all right, let's go 205 on a stop loss right here. If we go 205, I'm at 3.3. Right now, that's my cap. I don't want to go any higher than that. Okay, so that's right at the upper end. That's the most amount of risk I would take at all on any positions right now, is around that $300 range, or 0.3 of the position. That puts us at 1.88% of the entire portfolio with the stop loss at 205. That's my number of risk. If that's too high, then I can change one of two things. I can change two things, or I can change one of two things. If I'm not okay with that stop loss and this number, well, I might be able to move it up a little bit. It's at 205. And it's like, I'm going to raise it just under that to that 218, because if it did move lower and ultimately traded right here, yeah, it might find some support, but let me just get out of it. So let's change the stop loss there. Let's change the stop to 218 from 205, because I'm okay with a little bit tighter stop loss. That puts us now at 0.2, 200 instead of 300. And I was able to keep my same position size. So my amount at risk now is, the same, or excuse me, my position size is the same, but my amount at risk is smaller because I have a tighter stop loss. Okay, I could do the other as well. I could say I'm okay with this stop loss, but that's still too much. Now what do? Let me change the number of shares. If I go less shares, 7. Now instead of 200, I'm at 186. Okay, I could change this to 6 shares. Now I'm at 160. But look what's happening here. So I'm also reducing the position size. So now instead of a 1900, I only have 1400. Those are the two most critical parts right here in the money management process: your size of your position and your stop loss location. That's 218. Now I know. Okay, now I go set up the trade and I set up my stop loss location and I check it each day. Obviously, it's like, if it goes higher, let's check it. Do we need to adjust our stop loss? Okay, how do we adjust that stop loss? We know that we're adjusting stop losses by that 236 most of the time. I go to the portfolio and see, like, USAP. USAP, our stop is, we actually bought this back, I think right here. So we've had this for a length of time and we've just been rising that stop loss. So we're actually pretty close to getting stopped out. It's a little bit lower than that, but if it bounces, it's got this nice trend line in place, the support area, and then ultimately moves higher, then great, we don't get stopped out. But if it moves lower, we get stopped out, but we profit. We will have profit from here to here, even though we didn't sell at the exact top. That's kind of tough to do, because what if I sold here and I thought that was the top? What if I sold here and I thought that was the top? What if I sold here and I thought that was the top? What if I sold here and it finds support and ultimately rockets higher and we don't get stopped out? Okay, that's the game. That's the back and forth, and that's a hard part. That's one of the decisions to say, man, should I sell into the strength or should I allow for a retracement? Because if I'm doing that, I'm giving money back. Okay, I'm giving the gains back in anticipation for more, and because it becomes too much of a chore, of a task to know exactly when to sell at the top or exactly where to buy at the bottom. We want to give ourselves a little bit of leniency and a little bit of cushion by saying we're okay with a range, we're okay with a zone, we're okay with giving back a little bit of those gains in return for a little bit simpler management style and a consistent management style as well, by trailing that stop loss higher. And sometimes we get surprised and they move higher. This last 4 or 5 months, really 6 months, all year long, I think we've had a couple real big breakouts, but for the most part, this has been one of the bigger trades. Market conditions have just been really flat. If there are stocks that are starting to move higher, they end up pulling back as well. Okay, I'm gonna end on that note. Hopefully that you found that productive. That's a little more strategy. It's a little more tactic as far as the exactness of a process to say, here's what I'm doing, here's my risk, here's why I'm buying, here's where I would sell if it does get to this level. And as it moves higher, again, those of you that have been in these presentations all year long know that the rebalancing is where we're taking money off the table, either a stop loss or a rebalance. If it gains 100% and our portfolio gets a little bit too lopsided and one holding, maybe this raises up to 4 or 5%. We can sell into the strength, part of that winner. And we've actually done that on USAP. We sold half the position into strength. So we actually did sell into strength, and then now we've got a trailing stop on the rest of the position. And that's the way that we'll typically manage it, is sell into strength, but not the full position. Sell only a part of the position to bring the total allocation back into balance with our portfolio objectives. It's a more sustainable method, in my opinion, because it is not that hard to do. It's harder to pick targets and say, I'm going to sell at this target versus saying, I'm going to sell when my position reaches a certain size inside of my portfolio. And then I'm going to just take some of the gains, or I'm going to rebalance back to a more sustainable risk location if this becomes a little bit more lopsided. We'll get into that more on Thursday, and I'm going to end on that note. Thanks, everyone. Have a fantastic day today.